Welcome to Captive of the Week, where we take a peek into the shadowy world of onshore captives and how they use the Federal Terrorism Risk Insurance Program to shift risks off of their balance sheets and onto yours. This is your host, Jason Shoup, founder and managing member of the Centers for Better Insurance. This week, our captive is Ports Insurance Company. Ports America is the largest terminal operator and stevedore in the U.S., with operations in 42 ports on the East, West, and Gulf coasts. Ports America first set up Ports Insurance Company as its captive insurer in New York State on December 18, 2003, just a year after the Terrorism Risk Insurance Act became law. The following year, it amended its business plan to start writing terrorism insurance backed up by that federal program. As of 2006, Ports Insurance Company insured its corporate parent under a terrorism insurance policy with a $200 million limit. It's difficult to estimate the captive's deductible under the Terrorism Risk Insurance Program, but it appears to have been in excess of $3 million and perhaps significantly higher. Assuming a $5 million deductible, if Ports Insurance Company had to pay its corporate parent the full $200 million, U.S. Treasury would reimburse the captive $156 million. In turn, Treasury would levy a surcharge on small businesses, nonprofits, local governments, and other commercial property and casualty policyholders, amounting to $218 million. That's right. TRIA turns a $156 million government benefit to a large corporation into a $218 million tax on everybody else. Our trail goes cold in 2012 when Ports America moved its captive from New York to New Jersey to take advantage of New Jersey's newly enacted Captives Insurance Act. New Jersey entices captives into the state by promising strict secrecy protections, including that the Department of Insurance will not honor a subpoena for records relating to a captive unless the captive consents in writing. And that is exactly what happens. Right now, U.S. Treasury, the agency that has committed billions of dollars of our money to bail out captives under the Terrorism Risk Insurance Program, is in federal court trying to pry information out of the Delaware Insurance Commissioner about how onshore captives are used by their corporate parents in allegedly abusive tax schemes. As crazy as it sounds, Treasury is on the hook for up to $100 billion to bail out captives under TRIA, but has to sue state insurance regulators to find out even basic information about them. It's even more outrageous that Congress would seriously consider the Pandemic Risk Insurance Act, which would hand captives up to $750 billion under the same state laws against captive transparency. Predictably, these captives and their advisors can't wait. You can learn more about the Terrorism Risk Insurance Act and terrorism risk captives at www.betterins.org. On behalf of the Centers for Better Insurance, thank you for spending this time with us.